Hello, this is Steve Sanangelo from the SRS Rock Report, and today in this video update, I'm going to discuss the warning for the economic and market depression and why it's going to be a precious metals bull market. Now, to get started, I'm first going to focus on some of the economic indicators that are taking place that's going to negatively impact the stock market, the economy, but I believe it's going to be very good, very positive for the precious metals. Now, this is the chart of the Dow Jones. It's a monthly chart of the Dow Jones versus the Industrial Production Index. Now, in February, the Industrial Production Index was 109. It was way up here. March, it fell to 104. And that's when we had the huge sell-off because there was a lot of the contagion was taking place in Asia, and it was starting to move to the Western countries, such as in Spain, Italy, and then in the US. And we had the big market sell-off. Now, what's interesting, in April, it fell even further to 92. But that's when we started seeing the rally in the stock market. And in May, and this is the next ticker, again, each ticker here is 1 month, we continue to see the market heading higher, even as the forecast says, and I'll show you, that the Industrial Production Index for the US will fall to 84. Now, this next chart comes from the Financial Forecast Center, and they do some excellent work. It's at forecasts.org. And they have a forecast for the Industrial Production Index going all the way to December 2020. Now, they say it's going to bottom in August at about 77, 78. Now, if that's the case, and we're at 92, let's take a look at the next chart. This is the Financial Forecast Center's the chart for the Industrial Production Index. And here we could see this is the current number, 92, right here. So the current Industrial Production Index of 92 is forecasted to fall all the way to 77, that's down here, by August 2020. Now, what's interesting, in June 2009, during the lows of the economic recession, the Industrial Production Index fell to 87, which was right here. So this economic recession, depression, is going to be far worse than it was in 2009. And so what's interesting, we have to go back all the way to 1996, which is right here, to come back to the same Industrial Production Index of 77, which is the forecast for August. So that's how far it's going to fall. And then that's going to negatively impact the stock market. And if we look at this chart again, here we can see during the 2007-8 financial crisis, housing subprime meltdown, as the stock market declined, you could see the industrial production level was about 105, and it mirrored the stock market decline. Now, interesting, we had a huge decline because they're shutting down the economy, correct? And we could see that right here in the market selling off. But then it jumped right at this 18,000 level, and I'll show you why that's important. So even though we're going to see more weakness, more shutting down of this Industrial Production Index, the market continues to correct higher. I believe even though the Fed and central banks are printing money, at some point in time, the market is going to turn around and head lower. Now, what's interesting, the reason why we're seeing the markets turn around has to do with the massive money printing and asset purchases by the Federal Reserve. This is the total assets of the Federal Reserve balance sheet, and this gray area here denotes a recession area. Now, back in 2008, this was the Fed's balance sheet, and in 2 months, they put in 1.3 trillion. They purchased treasuries and mortgage-backed securities and some other things, other assets. But in just 2 months, we could see their balance sheet exploded. Now, what's interesting, there is no gray area here. We're not even in a recession. And in just 3 months, the Fed balance sheet has increased almost 3 trillion. Now, this has affected the stock market. If we go back to 2012, when the Fed was increasing its balance sheet from about 2.8 trillion, let's say towards the end, when they started a new QE program at the beginning of 2013, it was about 2.8 trillion right here. And we could see as the Fed's balance sheet went up to 4.5 trillion, so did the S&P 500. So in this 3-year period, the S&P index added 700 points on about 1.7 trillion of the Fed balance sheet buying assets. Now, what's interesting, if we fast forward to today, this is the huge sell-off of the S&P right into about the middle of March. And since the middle of March, the S&P has added only 500 points, but look how much the Fed balance sheet has increased, 2.7 trillion. It took 2.7 trillion to get the S&P up to 550 points. So again, it's this massive money printing that's trying to prop up the markets. Now, the reason why I've said in a previous article and video that it was a very important level, this 18,000 on the Dow Jones. This is the Dow Jones monthly chart. We could see the index rallied right at, it turned around right at the major 18,000 support level. Once it closes below it, down she blows. So this is the 18,000 level. We can see here for almost a year, it didn't go above it, corrected, kept hitting it. And then once it went above it in 2016, it tested it right back here, and then it went off to the races. Well, when the market sold off during this contagion, it went right down to 18,213 points. And so this is when they turned it around, because I can tell you from family members and friends, I heard that they were getting ready to sell their 401k. Their brokers were telling them to hold on, and things would have been much different if this Dow Jones would have fallen and closed below this, because then a lot of psychology, a lot of Americans would have started liquidating. They held on because they knew it was going to turn around. So this is a very important level for the Dow Jones, 18,000. And this here is the 300-month moving average for the Dow Jones, which is exactly where it touched in 2009. And I believe we're going to see that again. Even with money printing, at some point in time, when the overall economy, when the physical economy starts to disintegrate, the Dow Jones and the stock market cannot continue higher. At some point, we're going to see a huge correction. Now, another aspect before I get into the metals, this is the Dow Jones monthly chart versus the MZM money supply, and that's the liquid money supply. And it's hard currency, coins and banknotes, checking accounts, saving accounts, and money market accounts. Now, here's the Dow Jones index, 2008, the sell-off. And as we can see during the sell-off, the MZM money supply increased. And it's been steadily increasing. And look what happened right here when we had this global contagion. It shot up from 17.3 trillion to 20.9 trillion in 2.5 months. It shot straight up. And this is the liquidity that's been used to prop up the markets. So from January 2008 to June 2009, that's a year and a half, the MZM money supply increased 1.5 trillion. But in just 2.5 months, from March 2020 to May 2020, it increased more than double, 3.6 trillion. This is very inflationary. And I think we're going to start seeing, as we're seeing today, actually silver's up more than 50 cents. Gold was up more than $17. This is very inflationary for the precious metals. Now, this is a 30-year chart comparing the Dow Jones, S&P, gold, and silver. Even though silver is underperforming gold, it's not doing that bad over a 30-year period. Now, we did see the gold, of course, is in this gold line, and then silver is in the gray line. Silver actually outperformed gold during the 2006 to 8 period, and also during the 2010 to 11 period. Right now, gold is outperforming silver, but I think silver is going to surprise people because there's just not that much silver. And when the markets really start to correct lower again, I think we're going to see a lot more investors and physical buying And right now, the premiums of the silver eagles and a lot of these coins and bars is still very high. It's been more than 2 months now. Okay, now I wanted to just briefly go over the Dow silver ratio. And this goes all the way back to 1970. And on the low, when silver reached $49 in 1980, the Dow silver ratio was only 24. Wouldn't that be nice today? And then over the next 20 years, it went all the way up to 2,500 to 1. And that was peaked in 2001. And then as it peaked, it started to low and it went all the way down when silver again hit $49, $50 in May 2011. It hit 249 to 1. That was the Dow silver ratio. And over the last 9 years, it has trended higher. Well, let's say 7 years. So in 2018, it reached another peak right at 1,848 to 1. Now we're seeing another reversal, and I wrote about it broke the trend line. Now, this was as of 2 days ago. I think with silver going up another 50 cents today and the market selling off, this is a very important level. This 50-month moving average is very important because once the Dow silver ratio breaks it, it tends to continue lower. And once it breaks it on the upside, it continues to go above it. So we need to see this break below this 1,430 50-month moving average. When it does, this is the first. It'll hit the 1,300 to 1 ratio. Once it closes below that, I see it start moving down to the 600. And what that means, the silver price will be higher and the Dow Jones index will be lower. And just to give you a comparison, how different times are, and I'll show you why I believe the stock markets are so overvalued. In 1980, the average Dow Jones was 919 points. Unreal, 919 points. The silver price that year, this was the average, was $16.39. So the average for the year, not the low, was a 56 to 1 Dow silver ratio. Now, if we fast forward to today, Dow Jones index, as of yesterday, it's fallen today a bit. It's 25,400. The silver price yesterday was 1740. And so the Dow silver ratio is 1,460. And the reason for that is a lot of the inflation has gone into the stock market and not into the metals. And if we look at this next chart, this is the Wilshire 5000. It's just another stock index. And there's also the Buffett indicator, which is the S&P over the GDP ratio. And here we could see in 2000, it had hit 1.41 or 141%. Declined, and in 2007, it went to a little more than 100%. And then in 2007, it went all the way down to this 60% range. And here, over the last 20 years, it's gone back up to a new high of over 140%. Currently, it's at 137% or 1.37. The mean is right here, a little bit more than 80%. The markets are way overvalued. And I believe because the markets are so leveraged and so overvalued, I do believe it's going to fall back down to this 0.6 or 60%. For when that happens, more investors are going to move out of stocks, bonds, and move into the precious metals, paper, as well as physical. I do believe we're going to see more inflationary paper prices, but as time goes on, the driver of the silver and gold price will be physical buying. Before I get into the last few charts on gold and silver, I wanted to tell you why this is different. This is from the IEA, the International Energy Agency. It is the world oil supply and demand from 1971 to 2018. And we could see during the recession that started at the end of 1979 and went to the early 80s, we lost 9.6% of oil demand and supply. Basically, the world produces about the same it consumes. So there's not much of a difference. So about 9.6% during the 2008-9 financial crisis, it was 4.5% loss of demand. And in the last few months, since this global contagion, the safe estimate is 25% lower. Now we are seeing economies starting to recover. People are going out and driving, but even I doubt we would go back up to a 10% loss. And this is very bad because the markets are much more leveraged than they were in 1980. So I think the situation now in the stock market, the financial system is much worse, is much more leveraged. And this is very bullish for the precious metals. And lastly, to give you an idea how bad the situation is for the US oil industry, this is a chart showing Exxon, Chevron, ConocoPhillips, the three major US oil companies. It is their US and international upstream earnings. All that is their oil and gas wells versus their CapEx spending. It's the first quarter of 2020. Now, Exxon, Chevron, and Conoco together lost 900 million in their US oil and gas fields. They spent a stunning 5.6 billion in capex expenditures to lose the 900 million. Now, in their non-US or international upstream oil and gas wells, they earned 4.3 billion and they invested 4.5 billion. So here we could see the US sector is in serious trouble. So it's going to be much worse in the second quarter of 2020. So this is the problem. These major oil companies are making money in their non-US and international sector. Because of shale, it's so expensive that they're investing so much money and they're not making the money. I think this is going to get much worse. We're now going to see a peak and decline of US shale production, and that's bad news for the US dollar and the US economy. Now, these last few charts, I want to tell you what's really important. And these technical levels are paper trading right now are going to tell us when we're going to finally see a break for gold above 1800. So as we could see, there's three major levels: 1350, 1550, and 1800. And I said earlier this year, gold was trading in this ascending triangle right here. When it finally broke above this 1350 level, it shot right up to the 1550 level, corrected, and went above it. And now it barely touched last month, that 1800 level. And now it's trying to go back above it. The issue is we could see more of a correction in gold than silver. There's a glut now of gold finally coming in the traders. And the gold COT report is actually more bearish compared to silver. I'm not saying we will, but we could see more of a correction here. But once gold goes above this 1800 level, it'll shoot above it, it'll correct down. Once it stays above it, it's going to go up to 2000 very quickly. I see that happening very quickly, probably within the next 6 months. Now for silver, silver did the same thing. Silver was trading in this, I call it symmetrical triangle right here, it's long term. And what's interesting, it didn't go below this, bounced up here, and when it finally broke above it, it went up to this 1850. Silver also right now has three major levels: $14, 1850, and 21. You could see right here, silver has not broken above the 1850. And even though we had this huge sell-off with the market, there's no coincidence that it closed right here at the $14 level. That was in March, and in April, we could see that it right here, it didn't go below it. It opened right at the 14, and now it's actually getting close to this level today. So for silver, it needs to break above this 1850. Again, this is all paper trading, but this is what traders are looking at. And traders, once it gets above a certain level, then you see a lot of traders moving in. So I think we're going to see inflation move into the precious metals, the paper prices. That's over the short to medium term. And over the longer term, we're going to see more buying of physical. That will be the main driver of the precious metals in the future, is the physical buying. But right now, it's still going to be traders moving in. And I do believe as the markets start to become more problematic, there is going to be more money printing and inflation, we're going to see much higher paper, gold, and silver prices. So once we get above 1850, I believe silver will quickly go to 21 before corrects. And once it gets above 21, then it's off to the races. Well, thank you very much for watching this newest video. Again, I believe we've got some serious issues with silver more than gold due to this global contagion. We had silver was hurt the most. And I believe towards the end of the year, we're going to see more base metal mining taken offline because the economic recovery is going to actually slow even more towards the second half of the year. So there's going to be less copper, lead, and zinc production. And that means there's 55% of global silver supply comes from base metal mining. And with more inflation, more physical buying of gold and silver, I do believe silver is the underdog. I think gold is an excellent metal, precious metal to own as well. But I do believe this coming economic market depression is going to be very bullish for the precious metals. Well, thank you very much for watching this last video update. If you have not yet subscribed to the SRS Rocker Report YouTube channel, please consider doing so. Thank you.